So now let's go ahead and move on to our second segment, and we're going to adapt the normal demand and supply model to talk about trade, and first we're going to look at imports. Now, of course, we've already covered one model of trade, and that's the so-called Ricardian model, which was actually developed in the early 1800s by David Ricardo, who was a stockbroker and economist in London. And that let us show several points here. It allowed us to get the idea of comparative advantage and how it's different than absolute advantage. And remember, comparative advantage is about opportunity costs. Whoever or whichever country has the lower opportunity cost of producing a good has the comparative advantage in producing that good. And that's what dictates who should specialize in what. So once countries specialize in their comparative advantage, then goods are being produced where they have the lowest opportunity cost. And that means total world output can rise without using any additional inputs. So those are the gains from trade. And then, of course, there's some bargaining over who's going to get what portion of those gains from trade as embodied in the terms of trade or ratio of exchange. Our supply and demand model is going to allow us to look at some different things. The Ricardian model didn't really get us very far in looking at how trade impacts consumer and producer surplus or the welfare of consumers and producers within each country. And our demand and supply model will allow us to do that. The Ricardian model didn't have any way to analyze what the effects of trade restrictions are on consumer and producer surplus. And the whole idea of domestic supply and demand really wasn't even in the Ricardian model, and we're going to be able to add it in this new model. One thing to think about here as we're looking at an alternative model is how does this model differ from the Ricardian model? And one big way it differs is that the Ricardian model, of course, we had two countries. And those two countries essentially, by implication, were the entire world economy. Here, we have one small country. And the idea of a small country is one whose imports and exports don't affect the world price. So our small country is a price taker on the international stage, as opposed to the Ricardian model, where we really were trying to figure out what determined the terms of trade. So we're going to take the world market price of goods as given, typically, determined by overall global supply and demand. And our little country that we're modeling here is not going to be a significant influence on global supply and demand. That probably is not realistic for large countries like China or the United States, or if we thought of the European Union all as one country. But it's a useful way to look at it because even a large country like the United States is only about 20% of the world economy. So yes, the US can move world prices, but not as much as you might think. 80% of what's going on, of course, in the world is not inside the US. As a review, remember that when we go to calculate consumer surplus, we're talking about how much economic welfare do consumers get from participating in a market, and producer surplus is how much economic welfare producers get from participating in the market. And this is just a normal supply and demand diagram. We have added a new phrase here, what's called autarky. Autarky is a fancy word that means you're not trading with anyone. And of course, in a situation where you're not trading with anyone, the price is determined by domestic supply and domestic demand in a regular supply and demand framework. In that case, then, consumer surplus is everything above the price and below the demand curve, this blue triangle here. And producer surplus is everything below the price and above the supply curve. So it's everything in this pinkish kind of triangle here. Remember that we can actually figure out the area of this to get a numerical estimate here. And I'm just sort of going to attach some numbers to that previous slide. I'm going to say that that P max, that price where the demand curve intersects the price axis, is $120, that the equilibrium autarky price, PA, is $80, and the equilibrium quantity is 50. And if we go through the calculations on that, then the height of our triangle is equal to this segment here, so it's P max minus PA, and the width of our triangle is this distance here, quantity, so 50. So we get an estimate here of consumer surplus is 1,000. To figure out producer surplus, we're going to do a triangle with height equal to PA minus Pmin and width equal to QA. So we're going to go ahead and do our math on that and come up with producer surplus before trade in autarky is 1125. So now let's think about the trade. We've already laid the groundwork for what's going on in this country before we have any trade. Now let's think about what happens when there's trade. Let's first think about a country that has a comparative disadvantage in a good. And if a country has a comparative disadvantage in a good, what's going to happen is that its domestic autarky price is going to be higher than the world price, because this country is, comparatively speaking, inefficient at producing this good. So the price is going to be high. So what's going to happen is that once this country becomes open to trade, consumers are going to seek to buy their goods on the world market where prices are cheaper, rather than from domestic producers who are charging high prices. And as they do that, that's going to put pressure on domestic producers to lower prices until they match the world price. So in a drawing, what we do here is, if PA was the autarky price before trade arrived, what happens here is that the imported goods put downward pressure on prices until the price in the domestic market converges to this world price, PA. This is the price set by global supply and demand. And at this price, PW, this world price, the amount that people want to supply is where that price hits the supply curve. The amount that people want to demand is where that price hits the demand curve. Notice, of course, that people want to buy more than domestic suppliers want to supply at that price. So there's a gap here, and the gap, the amount that domestic demand exceeds domestic supply, is exactly equal to the amount of the imports. So what happens, of course, notice there's two things that happen. The declining price causes U.S. or domestic suppliers to want to supply less because it's less profitable. It also induces domestic consumers to demand more. We can think about the effect of imports on consumer and producer surplus. Initially, consumer surplus was this area W, everything above the old price and below the demand curve. Producer surplus was this area below PA, below the domestic pre-trade price, and above the supply curve. So initially producer surplus was X plus Y. And then, once we have trade, consumer surplus is everything above the world price and below the demand curve. So it's W plus X, this sort of trapezoid thing, plus this triangle Z. And producer surplus is just this remaining triangle Y. So if we sort of look at a ledger of who gained and who lost and how much, there's two things that go on here. Consumers gain X and Z. X is a kind of redistribution from producers to consumers. So at an overall societal level, that balances out. It's neither a gain nor a loss. But Z is a genuinely new gain from trade. And it's a new gain from trade that comes about because essentially we're able to have more goods that we get some enjoyment out of. The microeconomics textbook places a large amount of emphasis on sort of dividing up this area of gains, what I'm calling Z, into two different chunks. One is this sub-triangle to the left here, and they talk about, well, there are real societal costs to producing these shoes between QS and QA. We used materials, we used labor, we used machines, and once these are no longer produced, we can redeploy those domestic resources to some alternative use where they're going to be more productive. And then over here, there's the gain to the consumers. That's sort of a pure gain of consumption. So I don't know whether that way of dividing the gains adds or more to the clarity of the presentation, but it's certainly something to think about.